Hey, everybody. Welcome, welcome. Hope you're all doing well and happy. Just going to do a little audio test. Well, I'm sure everybody's good. I can see that I'm broadcasting. I hope you're all well and happy. It is our regular monthly YouTube session, live market analysis and the SVB crisis. This is Sam Evans with you of Pinnacle Institute. Hope you're all doing good. Thanks for being here. And it's Friday, March 17th. Hey Daniel, how are you? Good to have you guys here. Remember, we have live chat today, so we're going to be together for about 40 minutes or so on this Friday afternoon, and then after that, I am taking the rest of the day off. Um, Crazy market, crazy times, and if this is your first time you've been with us and been on our live channel right now, do us a favor, go ahead and click on the subscribe button right there for you, and you'll get all of the updates on when we're actually doing these live sessions. Every one of these sessions is recorded as well, so we can, obviously feel free to ask questions right now while you're in the session. But also, more importantly, you can also look at the recordings as well, and you can reach us at any time by going to pinnacleinstitute.com. Just before we go, we've just pasted a link in the chat box for you there, link directly to register for one of our upcoming advanced trading and investing workshops. Join us to learn how professional traders come to the market and do what they do. Next one is actually tomorrow at 10 a.m. Eastern time. We have another one next Wednesday at 11 a.m. Eastern, and then next Saturday as well. And you can find out more about joining us for a whole week of what we call our Advanced Elevate as well. So that's what that's all about. Hope you get a chance to join us, to be with one of my colleagues, Sam Seidel or Steve Moses. Man, what a crazy time, hey, in the market. I mean, this is what kind of like trading dreams are made of, or maybe even trading nightmares are made of. I'm going to go over to the charts right now. If you've been living under a rock, yeah, you wouldn't have heard this, but if you haven't, we've seen Silicon Valley Bank, one of the largest banks, especially for, tech company startups and so on, coming out of California, bankrupt, went under this week. Signature Bank went under as well. We saw Credit Suisse bailed out to the tune of $64 billion by the Swiss government yesterday. And just announced as well, the First Republic Bank has had a $30 billion bailout as well. Wow, crazy, crazy times. I've said it once, I've said it again. When we look at these markets and we see how these things are, it absolutely amazes me. It absolutely amazes me how, it seems that the banking industry is the only industry in the world where people get rewarded, literally rewarded for being reckless with money. As traders, if we're reckless with money, it doesn't typically bode well for us, right? How nuts is that? Yeah, it doesn't seem to matter in the banking industry, but hey ho, there you go. One of the reasons why I feel we trade and why we do what we do, and any trader who I've met in my time who is motivated to be, a participant on an ongoing basis in the market, will always say they love the freedom that it offers them. And I do like that. It's a beautiful business in that regard. And what I thought we talk about today is, fundamentally, what does this crisis mean, for the coming year ahead and maybe even beyond? But more importantly, what are the key levels we're looking at and how we could be trading this too? I want to just flash forward to, I've got the S&P up. Now, I use the S&P futures in my own trading that I do. I trade the S&P pretty much exclusively on a day-to-day basis nowadays. Over the years, I've flirted with NASDAQ, Dow Jones, all of those things. But I'm a big fan of trading the ES. I like it. It's the biggest of all the stock index futures. A little bit more volatile for some. Some people are like, oh man, a little less volatile, I would say. But lately volatility's been really solid, really good. Quite enjoying that in that regard as well. So, um, but let's look at this. I mean, look, people ask me this. Look, we can look at any of these markets. We can look at the Dow. Okay, and here's the Dow Jones right now. I'm going to clear off some of these. I want to kind of like remove some of these lines so everything's clear. We can look at the Dow, which is typically what the press will talk about. We can look at the NASDAQ, which is the mighty tech market, okay, which is retesting some highs right now in the market as we speak. We can look at the Russell, which has been a personal favorite of mine over the years as well, which is having a really bad month right now. And I think that's a big tell. And I want to talk a little bit about the Russell over this course of this. session, and we can look at the S&P. You know, I want to really look at the S&P and the Russell in a little bit more detail. Personally, you know, I want to try and give you some tips and tricks. There's only so much magic, you know, we can hope to perform in 40 minutes or so. But actually, it's not magic. That's a poor choice of words. In fact, if anything, I would just say trading is less about magic and more about being consistent in what you do. But, you know, I think that the interesting thing about the markets right now and where we're at right now is I think we can learn the most by looking at the S&P 500 and also looking at the Russell. And I'm going to explain why as well. Let me just remove on here volume. Just so I got a bit more chart because volume doesn't mean a thing. There you go. Isn't that nicer, guys? That's a lot nicer. Okay. It always amazes me how fickle traders are. You know, the people who just live on the internet, just looking for the next big thing. You know, it's so funny. Half the time you'll talk about consistency and being boring, and they'll just turn off because they're like, oh, you know, I want something different. You know what? The best thing you can do is is just to stick to one thing and a very, very simple methodology, you know, and just make it till it's pretty dull, right? But anyway, that's just my opinion on it. But listen, let's look at the S&P on a daily chart. Now, the whole SVB crisis started to kick off last week, really kicked in. All the rumblings were coming out last Thursday and Friday. And then look, we've had 5 trading days. Let's zoom in a little bit on here. Okay, let's zoom in a little bit on here so we can see a bit more of this, okay? And I want to stay on this daily chart here for a second. Now, let's look at this daily chart. This is today, Thursday, Wednesday, Tuesday, Monday. So last week, Monday, Tuesday, Wednesday, Thursday, Friday. Monday, Tuesday, Wednesday, Thursday, Friday. Look at the big downward push that we had. And that downward push came on this daily chart from this area of supply. We call this a pro gap. And this is what's interesting about this, right? This pro gap here. And I want to talk about this because some of you tuning in right now might want to say, well, look, everything's going on. Things are pretty bad. How do we deal with this moving forward? Let me go on record and just say this. Be very cautious. The fact that one bank got into that much trouble, and it's a large bank, Silicon Valley Bank was a large bank, and now we're seeing Credit Suisse, we hear rumbles of Deutsche Bank, we hear Wells Fargo, First Republic. If one bank's, all the banks, typically the system is very much interconnected. It's all very much follow the leader. If one bank's making serious mistakes, it's probably likely that another bank is making serious mistakes as well. So I live my life by a concept of Vulcan logic. You know, any of you Star Trek fans out there will know exactly what I mean. But logic, like a Vulcan logic, is just look at it for what it is. Vulcan logic to me simply dictates that if one bank has had this much kind of trouble, and there's literally hundreds and thousands of different banks in the world, it's probably likely to assume, or easy, or we should assume potentially, that other banks are also kind of in it deep as well. So I don't feel like this is a problem that's going to go away. Okay. I feel that any kind of rallies you see in the market, treat them like my first piece of this is me personally. This is for educational and entertainment purposes only. You need to be responsible for the trading that you do, friends. Okay. However, my attitude right now is I'm shorting rallies. Okay. And I'm getting good moves on the shorting of rallies. When I talk about shorting rallies, take a look at some of these rallies here, right? 2 good rallies we've had over the last month or so. Shorting this gap here. And we call this area here a pro gap. That was an interesting thing. We've been in an upward trend, and then we had a gap in the opposite direction of the trend. And when that filled, this sell-off started to occur from here, okay? Now, the news didn't start to come out until the bottom of the end of the week, right? Last week, this all news started to hit. You know, all the proverbial stuff hit the fan around this candle here. Let me expand it for you a little bit. What's interesting enough, though, is the sell-off itself started here. When it comes to fundamental information, don't ever expect that you're going to get a perfect lineup of fundamentals and technicals at the same time. This is why when I say to you, I feel fundamentally like things are going to get worse and could get worse, I mean it. I really feel like things could get worse. However, that doesn't mean I'm just going to sell the market all the time. Because if it was that simple, that's what everybody would do, right? And I think that this week, these rallies that took place right here and here and here took a lot of people by surprise, okay? And then we've had a good drop today from this area of supply, and we have demand below us. So the clue about everything was here. The clue was when this market started to sell off. This stuff's been going on for a long time. Don't tell me that the powers that are in control didn't know about this. Okay. So what we're seeing here is kind of like an opportunity, and I'm going to expand this chart up to just short the rallies. And guys, if you've been shorting rallies, you've been doing pretty good over the last year or so. Now, what you need to understand is to make sure you have profit margin. I would say, hey, on everything I'm seeing right now, I want to be smart about profit taking. Now, the key areas of demand and supply are right now. This area at 3990 to 4,000. Look at the big round number height in there, 4,000. On the downside, you're probably looking at about 3,800 as your key metric on there as well. I would not be surprised, guys, and this is just a prediction, to see this kind of price action maybe happening for the rest of this month. Okay, at least until the end of the first quarter. That's about 2 weeks away. That's about 2 weeks away right now. I could be wrong, but this screams to me as a big jumping on or jumping off point. Take a look at this monthly chart. Look at this. We have been directionless in the market now for one. Let's write this down. 1, 2, 3, 4, and now we're in month 5. We've been directionless in the market for close to 6 months now, guys. And we got a couple of weeks ago. It would not surprise me to see this candle closing somewhere like this. Okay, that would not surprise me in one bit to see this candle do something like this. It just wouldn't. However, my personal long-term indicators that I look at are still saying that there's downward momentum in place. Now we take a look at this. Lower lows, lower highs, lower lows, lower highs, lower low. That is technically a lower high. And that screams of the opportunity to do a lower low in that regard on here. That's why I'm looking at this at the most basic level. From a monthly perspective, I'm still bearish. However, we've been ranging for 5 months. So what you got to understand is any positions we're taking to the downside, we got to be pretty systematic about how we manage our profits on that. This is a really weird conundrum, Fuel. We almost got to treat this market like a bearish ranging market. Now you might be looking at it going, what? That kind of like doesn't make sense, does it? A bearish ranging market. Yes, you did hear me say that. A bearish ranging market. Why? Because it's like we're drifting. We've been doing that. Look, we had sideways action when we sold off here. It sold off, then we had some sideways. It sold off here, then we had some sideways. It sold off here, we had some sideways. We're getting a little bit more now. We're going through patterns of drops over the last, well, this high was back in 2022. Over the last year and a quarter, we've been getting a series of drops on these daily charts. We then have these ranging periods. And that's what I expect is probably going to be happening right now. You're seeing it very clearly on the daily charts. Okay, take a look at the weekly charts, friends. You see on the weekly charts as well. There's our weekly chart right now, just coming off of that area. Then it's ranges. This is what we call in Pinnacle an area of fair value. And if you're finding the trading conditions a little bit challenging right now, it's because you're in the middle of a range. You're in the middle of a fair value area that's been going on for nearly a year. Oh, look, it's May. There's May. So just shy of a couple of months off. We've got 10 months of ranging activity in the market right now. So from a long-term perspective, yes, there is weakness in the market. From a long-term perspective, we are seeing lots of opportunity for the downside. Yes, but I'm still prepared to buy dips in the market. I'm still prepared to buy demand areas in the market. But I'm being very mindful that the market has been having a propensity to keep drifting lower. So what are the key levels? That's one of the things I'm seeing on here. That's on the S&P. Okay? When you really look at it on the weekly chart, you can see that price action. Okay. Take a look at the Dow. Now, the Dow's been a real strong one. But what's really interesting to me about the Dow Jones that I've noticed is the Dow very clearly dropped, retraced back. And this is classic. This, guys, is textbook crash patterning, right? I've been fortunate. I've traded for close to 20 years now. So I've been through, like, I've seen what happened after the dot-com bubble burst. I saw what happened in 2007 and 2008. Saw during COVID, all of this stuff. I've been in the market all those times seeing it. And this doesn't really surprise me. What's very interesting about the market is this initial push that we started to sell off without any really bad news. I called it the recession sell-off. Then we've had a rally and then bad news has come out again. This reminds me very much of what happened to the market back in 2008, 2009. Okay? Well, just 2007, 2008, excuse me. And the Dow has been the strong one. But let me ask you a question. Does that Dow look strong right now? We had a big weekly close lower last week. We've tried to top out at 32,500 this week. We're back down off of there today. Probably looking like we're going to be closing relatively low on the week anyway. And there's a wide open cascade of space on here. And the biggest clues in the market is understanding that we're not even in fair value right now. Fair value is here. There is no fair value below us. When there's no fair value below us, you've got to keep looking and seeing where really fair value is. And truthfully, to me, fair value is around this area here. You take a middle line in the sand from the middle of that, guys, you're going to about 27,500 on that. 30,000 looks like a cakewalk to me. 30,000 looks like a very easy proposition right now. When I look at these weekly charts, I'll be looking at somewhere like that, and I'll be saying to myself, this is likely where this has got a good opportunity to go. Now, even if we do get a rally, here's another tell for you on the Dow Jones, and let's just bring this up. So while it's had that strength and it's been showing that strength, what it's now been doing is it's been showing weakness, exaggerated weakness. What do they say? What's the saying? The bigger they are, that's right, the harder they fall. Bigger they are, the harder they fall. That's what I'm seeing with the S&P. It's had that really strong push upside, and now we're seeing that little bit of a rollover. Okay. And not really surprised by the price action I'm seeing. What's interesting to me is when I look and I see on these weekly areas, very good quality, clean levels of supply. Now, I like the supply level, by the way. I'd be shorting rallies back up to this supply level, 33,081 to 33,590. I don't know if it's going to get there. You know why I don't think it's going to get there? Because we probably retraced about half that move right now if you actually take some Fibonacci tools. And yes, sometimes I'll look at that and see, yeah, bang, look, on the money pretty much. We retraced half of that move over this, and we're seeing selling pressure coming. That's a real sign of weakness in the market. We couldn't even get back to that level of supply. But if we do get back to said level of supply, I wouldn't be too surprised to see this market go down a little bit further. Guys, I'm very aware that I'm speaking quickly today because I'm trying to get through as much as I possibly can in the time that we've been permitted on this live session together. So this is my key area. I don't see any quality demand on this until we get to about 30,000. So any good quality rallies that I see in the coming days, I'm going to short them. Okay. Do we have any? We had one here. We've got another little pocket of supply right here, just hovering around. And again, I'm on the daily charts now. I'm going to try and give you some key levels, which I can. And look, we've got what we call level on level right now as well. So we've got another little level right here. And this 3283 might front run before we even get to the absolute high point of that. So the near area 32,813 to 33,000. We get into 33,000, we're probably going to get a little bit of a drop off and go. But again, when you really look at it on this daily chart, you can see so clearly why there is just such a lack of good quality demand to even see where this price can go. It's all that much lower, guys. So when I really look at that Dow, that does look very weak since Christmas time, doesn't it? So, you know, that what was strong is looking a little bit weaker. Let's slide on over to the NASDAQ next. And then I want to do the Russell because I think the Russell's the biggest one. I think the NQs really took a few people by surprise, especially considering that SVB is a tech bank. It's like, yeah, you know what? But if you start to really think that the market has anything to do with the news, then you're going to soon get humbled. I tell you that right now. What is very interesting to me and what I was looking for right now is I've been looking for this 13,259 region to 13,740, which to me is a wonderful little area where we had another one of those all important, as we described them, pro gaps. Okay, here we are, pro gap again. Where's that pro gap? See, it closed and then it gapped down. Now, when you see a pro gap on a weekend, that's kind of important. Why is that kind of important? It's important because markets are closed over the weekend. A lot of things go on, right? It's always funny how bank collapses always happen on a Monday or going into the weekend so they can meet payroll, right? Make sure everybody gets paid, okay? And always happens around this particular time. And oh, good stuff. Thank you, buddy. Thank you both for your comments. I think that, you know, when you see a pro gap like that on a weekly chart, you know, that's a big deal. That's serious institutional selling. I've been really seeing, I'd love to see the market get to that particular point and then roll over. That's what I'm seeing. But what's really tricky about this is you had another pro gap right here as well between these. And it's hard for them to see. You almost have to train your eyes. But what we're seeing right now on the NASDAQ is a level on level scenario. And my colleague Sam Simon will always say that. He goes, you know, what's more powerful than a supply zone? two supply zones on top of one another. What's more powerful than a demand zone? Two demand zones on top of one another. And that's what you're seeing on this NASDAQ contract. Two supply with gaps in here. Nice topping tails in this particular region. You know, the charts are a living, breathing creature, basically. That's what they do. This is what they show us. And I will say, when I look at this chart, you know, I don't, it's scary, because what I don't see is any really good quality demand on this market until we get down to around this region here. Let me go mark this off on the weekly chart. I don't see until we get down to here. There you go. And that's like in that region of 9773. Now that's on the weekly chart. But what's really interesting is if we actually get it to match up with the monthlies, that's what we call a rally-based rally. So what you could actually now do is tighten that up, and you can see it on the monthly charts. That, to me, is where that next demand zone would be, around the all-important 10,000. I don't class anything on this monthly chart as demand. I really, really don't. And I would say to you, Michael, that lower fair value, yep, I mean, absolutely, but it'll have to deal with the fair value area first, Michael. That's exactly what that's exactly what you do. Like, it's likely to go to the fair value, absorb some of the orders, reestablish itself, and then go down to the next one. And that's really all markets do. They go from one fair value area to the next. The trend is the action between the fair value areas. So the bigger picture weakness in the market suggests that that's exactly, you know, what could happen in that regard. If I quickly go back to it. I would say this is your zone right here. This is your area that we're talking about. See around here? But we got some zones to take care of first before we do it. But if those zones break, yeah, you're probably looking around this area here, okay, which would line up quite nicely with this demand zone, 27,000 to 26,000, which is exactly around that particular area there. You see that area there? And look where that's located. See how I just marked it off? So a fair value area on one time frame is a demand area on another. See that? Like a fair value area here is actually a representative of a supply area here. You know? That's where you start to see it from a different perspective. So let's just do a little checklist here. Dow looks weak. S&P looks weak, pretty weak. And it looks weaker overall from where its highs to its lows, right? I mean, just remember, by the way, just to put that in perspective, if you take the high where we traded to where we are currently right now, market's down 18%. Market's down 18%, okay? If we look at the Dow and see where that is, high, down 13%. But the problem is it's not down that much, and it was down what? 22%, right? So it's definitely got more room to go on the downside in that regard. Okay. Now look at the NAS though. Oof. NAS looks like it's strong. Is it that strong? I don't know. Take the high to there. We're still down nearly 25% from Q4 in 2021. Isn't that crazy? So we're still down 24% from that area, you know, and that to me is that's a tell. So while it looks strong, it's actually incredibly weak, and we've been getting hammered. This market has been getting hammered for quite some time, and I feel that what we're seeing here is the possibility for this to push a bit higher, but hit into this area here. I got to say though, if the other markets roll over, this is the area that's going to hold price action. If we close around this area this week, I'm expecting more downside next. Okay. So the NQ to me is clearly at some good. I mean, look, why do I like these areas for supply? What did the price do from these areas? Broke down quite a lot. Okay. And I tell you this right now, if you're struggling in these market conditions, all you got to do is stick to the extremes. Stick to the extremes. What do I mean by that? Sell at the extremely high areas and buy extreme low areas. All you need is the odd one to hold, and you will be golden. All right. That's how you need to operate. So stick to the extremes and you'll be good. So we got an NQ that deceivingly looks strong, but is still down heavily. And also in some really nice, and there's some fresh supply there that produced new lows. Again, think about this. High produced a new low. Do you see that, guys? So that's an important part of all of this. So, S&P looks pretty weak. Dow looks like it's pretty weak. We're getting the idea potentially that the S&P is, we're getting the idea that the NQ is strong when it isn't really. Let's finally look at the Russell. And then I want to go back and I want to look at what this market looked like in 2007 and see if I can see any consistencies. Now, tell me this. How does that Russell look to you? What does that Russell look like to you? Does that look like out of all the... Now, this is the fourth of the major indexes. Does that one look strong to you? Or does that one look a little bit weaker? Should we see? Take your high. So right now. Ready? Ouch. 27.45% down. Now, here's my question. Why is that significant? Well, of course it's significant because we've been getting crushed and it's bad. It does look weak, right? I'm just going on numbers here. I'm not even talking about supply and demand. I'm just going on pure numbers. But the Russell is the 2000 small caps. Listen, if the mom and pop shops and the small caps and the smaller businesses are struggling, that is not a good sign. Because who's more likely to have the cash reserves? The big established companies in the S&P 500 or the smaller cap stocks in the 2000 Russell? The bigger the beast, the bigger the cash reserves you expect, right? The more resources at hand. If the small companies don't have the resources, friends, that is going to drag everything down with it. You can't have just the big companies surviving and the little ones anymore. That is a tell. And what you're always going to see, I don't want to use the term leading indicator, but what you could see as a potential leading indicator in all of this is the Russell. And that's how I treat the Russell, friends. Giving you a little, just a little Sam Evans nugget of some kind there to just give you some food for thought. I always look at the Russell as my leading indicator. And that's a sign. There's a sign there that basically, you're seeing some serious weakness in this market because the small companies are getting hammered, And that, to me, I don't really feel... I'm going to go to the daily charts and the weekly, the charts again and look at this. I don't see any good quality. I mean, there was a demand area down here, but the next demand... I mean, look, you do have a demand area also here, which is holding up. But the problem you've got when you have zones that keep getting tested multiple times is they're eventually going to stop getting tested. Now, again, this has been ranging for some time. Can we agree on that? Of course. So could it carry on doing this? Yes. I would be preparing for range-bound conditions maybe for the next couple of weeks or so, maybe until the end of this quarter. I would just be preparing for that. I would try to go to the market not being too bearish. I try to go to the market not being too, doom and gloom. Because any bit of good news, like a bailout of a bank, is going to be interpreted in the market as a good thing because it's just prolonging the pain. And that's a funny thing because that's how markets typically work. It's all about prolonging the pain. And when you prolong the pain, it just takes the edge off. It's just putting off what's inevitable. So, guys, at this particular stage, I feel we could go lower. I'm still happy to short rallies. Absolutely. There's some lovely new supply zones forming, on this Russell right now. When I look at the daily charts, I see it. Look, this gap here literally reacted yesterday, closed its gap, and off it went. We take these lows out, I'd just be shorting rallies. There's no quality areas on this daily chart. So I wouldn't be surprised. The Russell's telling me we've probably got a few more days of downside to go before we recover. So that's my tell. That's my tell. What is really going to be the signal, though, that we're in trouble? I got to see back to that S&P, right? And, I look at that S&P today. We're probably going to close near the lows. This is a pretty bearish candle. The fact that we couldn't even retest the previous day's highs We've got like kind of a harami kind of thing going on here. This looks ripe for a pushback to the downside as well. However, I would need to see, 3,800 taken out cleanly, this 3,800 area taken out cleanly to really see a bit of a capitulation in this market. So at the moment, my advice is, short the rallies and be smart on the profit taking and let a bit run. Or if you're going to buy the lows, try and buy near daily demand areas. The problem you got is there just aren't a lot of good quality demand areas. Again, if you want a number, if you want an area where I think has got a good chance for a good little bounce, it's 3,700 here, which is an untested area, something called secondary evidence right in that region there where the market almost got to that area. That would be a great opportunity for a bounce. This is junk. This to me is fair value with a little bit of demand icing on the top. It's not a clean area. The left-right price action on here, if you come to one of our webinars, you'll hear all about this. This price action that you see here is not indicative of a good quality area, okay? And what's interesting is this. Notice this demand area. It got tested here. What did it do? It reacted at the opposing supply area, didn't blow through it. So that tells me that supply is in control right now, which means I'm expecting lower prices. That's how I gauge it, right? The fact it's gone from zone to zone, held, hasn't managed to make a new high. It's now like a game of tennis. It's coming back down to this area here. That's a sign of weakness. That is a sign of demand being respected, but not being in control. Right now, guys, supply is in control. You can see that on the weekly charts, on the monthly charts. You can see it on the weekly charts too. That makes sense, guys? So I think that, the best bet you can do right now is, don't be looking for long-term positions. This is where options are really awesome as well. Don't be looking for really long-term positions. Just be looking for those extreme areas around those daily charts. I think it's difficult to lean on any major levels right now because we haven't had a domino of bad news happen quite yet. But I believe it will come. Now let's go take a look at the SPX. In fact, we can even look at the S&P on a monthly chart. And let's go back to 2008 and see if we can see anything similar. All right. Maybe even go to a weekly chart. Let's see how much data I've got on this weekly chart. Oh, yeah. Look at this. This is what I love. Let's get a little bit more data on here. Is it going to give me the data? Oh, that's as much as I can get. Oh, that's a bummer. All right. I'll go on the monthly chart then. It's all good. All right. Why don't I do this? Let's go to the SPX. Get some real data on here. Here we go. Weekly chart. Take a look. So here's the market from 03. This was the dot-com bubble. Then we started grinding higher, grinding higher, grinding higher, grinding higher. Here we are, 2008. Now, let's take a look. It all really started in 07. Take a look what happened. We pushed higher. We had a dip here. We pulled back. We rallied again. It's like there were rumblings in the summer of 2007. Then we peaked out in October of 2007. You see here? And then, after peaking out, we formed a supply and we dropped. And it wasn't until over a year later that we came back that the pain really started to happen. So clearly there were issues from here to here. We rallied back off of demand, right? Came back again. Oh, we got everybody excited because we made a new high. Then we sold off, hit again, and we went back to the supply. And then after that, it was all very ugly until early 2009, where we shifted. And once we broke through this area here, off we went. That was the clue. That was the clue. We started to see, let's go back here. We started to see areas of supply coming into play around this area. And look, we were a little choppy and a little rangy for about just under a year. And it was a big period. This whole period here, guys, was accumulation and distribution. And then finally, it gave up and we got the move to the downside. off we went. That was all a ranging period. This is what reminds me of what's going on right now, except it's a little bit more slow and steady, because if you go over to the chart now, this happened here, and it's forming these new supply areas, and price keeps respecting all of these supply areas that we keep seeing on here on the way down. And this is why it's a little bit unlike anything else, this market right now. What's truly unlike anything else is it's a little bit slow and steady. It's all just happening, you know? It's just like supplies being formed, markets selling off, markets coming back to zones. Heck, it's not even making it back to the exact supply zones. It's just showing me it's giving us a little bit of hope, and then it's going down again. And that to me is exactly, you know, one of my concerns is I don't believe we're going to get a full market collapse in one day. Like the problem with 2008, let me go back to 08. I'm really glad you like it. 08 happened real quick. Look, it all kicked off and then it went. Look how quickly it happened over like about 3 weeks. It was 3 weeks of mega pain. It just kept going, and then it recovered, right? It was all over about a 3-week period. We could get that, sure. But we're so high now that I see more, guys. I'm just my opinion. Remember, more of this. Just drifting into a long-term bear market. That's what's happening. To me, the bears just keep setting their traps. The bears are here. The bears are here. The bears are here. They just keep laying, marking their territory, and every time the price comes back, bang, they snap it again. That's what you need to be mindful of. So you're going to get opportunities for a bounce. They want that. Every time there's a good bit of news, it'll bounce. But what I call this, you know what I call this, guys? This action from here to here, this is the bear market that never happened. It's the phantom bear. Why? Because press aren't talking about it. The press have not been talking about the fact actively that the market has been going down since Q4 2021. They're still obsessed by the whole relief rally. Oh, look how far we bounced back after COVID. Yeah, really. Look how great. They're still living in that glory right now because, hey, look, market sold off 35%, right, before COVID, during the COVID thing. And it's like, oh, yeah, look, it rallied all the way back, and then it was 40% higher. Look at where it is right now off those highs. You're only 13% higher. 13% higher in 3 years. That's an investor's nightmare. Don't want to talk about that because the big thing is you're only 13% higher than you were, and you're 18% off the highs. Go figure, right? The bear market, the phantom bear, as I call it, the phantom bear. And I think that, you know, looking at markets around the world, I can finish up with this if you like, for sure, Edge. Where these markets are right now on the euro, it's an interesting one. I think there's a lot of rumbles. That was a previous supply level. There was a lot of rumbles about, you know, digital currencies in the markets right now and all these kind of things. I got to be honest with you. I look at the euro and, yeah, we had our bounce off of this demand area here, which to me was, you know, great timing with the dollar, and it overshot that area. So to me, that area is dumb. But parity is the flirtation right now, and we're still making lower lows and lower highs consistently in this market. And whatever way you look at it, that dollar's got a so great amount of upside right now still available to it. I have to say, you know, unless the euro can reclaim 115, we're staying lower. We're going to retest parity again. We get some serious issues with European banks. This thing's going lower. And I think that, you know, the money will go and flow back to the place it knows. And until they replace the dollar with, you know, some central bank currency or anything like that, the dollar's going to remain the world's reserve currency. And so, you know, when I really look at the price action that I'm seeing on this market right now, I don't have any reason to think that the euro is in great shape. This push that we had here, a lot of people looking at this as an inverse, maybe head and shoulders forming. Yes, but all right. I think I might have lost everybody there for just a second, but as I was just saying to you, Edge, I think these monthly zones are in control right now. 1.1 is the new normal. 1.1 is the new normal. I expect a retest of parity, and that area does not look good. If that area gets broken to the downside and the dollar rallies on fundamental reasons, we're probably seeing about 0.85 again on this. Okay. All righty. Then we just kind of like buffered a little bit there and caught up with ourselves. Guys, I'm glad you found that helpful. So, it's tough to call. I'm expecting a lot of chop in the market in the coming weeks. Be patient. Don't be too bearish. Don't be too bullish. And you generally, I think, will be okay on this. If you want to find out a little bit more about how to handle this information and what to do with it, come to one of our workshops. Come see what we're all about. We've got a great team of people willing to help you in as many ways as we possibly can. So I hope you found that useful. I'll leave this up here just for a little bit. Our next upcoming dates. Guys, you guys are always awesome. Once a month, I come and do this on a Friday afternoon. Thank you for being here. Thank you for taking time out of your busy schedules to listen to me go on about what my stuff. I'm glad some of you found this useful, not amusing, but useful. And I wish you nothing but safety and success in the market. It's pretty volatile out there. Please be careful. God bless you all, okay? Have a great rest of your day, and I'll see you next month for another YouTube live session. Take care, everybody, and thank you. Goodbye.